Good afternoon, everyone, and hope you have enjoyed the morning session today. I know I'm the last person standing between you and the first lucky draw, so without much further ado, I'm Timing, research analyst with the Global Fixed Income team, and here representing on behalf of our product financing team over there to bring to you your strategy into 2025, the bonds financing playbook. What is financing? For those who might be new to the idea of financing, let me give a quick and simple introduction as to what margin financing or leverage can do. Just imagine for today, you're holding on to $100,000, thinking what you can do with it. The sum isn't small, but yet at the same time, you feel like there are limitations to what it can give you. Diversification, use, assets. Perhaps more can be done if you just had a little bit more. And here comes financing, turning your portfolio of 100,000 into a maximum 3.5 times with the FSM1 financing facility into 350,000. And with this amount, you begin to realize, hey, there are much more things that you could be doing with it. Instead of just going all in into the equities or into one asset class, you can go in for more. And of course, the possibility is endless. Just up to you how you want to be utilizing this portfolio and maximizing your gains for your facility. So coming to FSM1's margin facility, just highlighting some of the key features we are able to offer to our accredited investors. So with your current FSM1 account, there are no additional steps being required for you to gain access to this facility. Just head into margin facility, opt in, and within seconds, you'll find yourself being able to utilize margin for investments based on your current portfolio and holdings with a maximum loan-to-value ratio calculated for you almost in an instant. Secondly, your cash remains as your cash. You need not worry about the margin depleting your auto-sweep cash solutions balances. You can opt in to repay your margin financing loans at any point of time. No restrictions, only freedom. And building on point 2 once again, your cash remains as your cash as long as your margin ratios are being maintained at the required levels. There are no restrictions barring you from trying to withdraw your cash balances. Of course, don't forget your ongoing financing at the same time. And lastly, making your life as investors simple. With FSM1's margin trading facility, everything is already consolidated for you in this app itself. You need not think about the complexity of handling different accounts, different items. Everything is combined and made easier for you. Within a simple click of a few buttons, you can get started on your margin financing journey with FSM1. And trust me, it really can't get easier or simpler than this. So with the introduction finally being done and coming to the key highlight for today, margin financing is actually not new in the market for those who are familiar. And even for us, we have been pushing for Japanese yen equity funds as a really strong pick for financing. In case you're wondering why, for one, since Japanese yen is still undoubtedly offering the cheapest loan rates across the markets, and for two, for those who are familiar with IFA's research, the Japanese market has been a key core for us since 2023. And we see this benefiting investors in general, and even more so for investors who have invested with financing. But nonetheless, changing that direction and topic slightly, you don't have to be limited with equity options for financing. And today, I'm here to share with you how bonds can be an amazing option for you to consider for financing as well. As compared to equities, fixed income through bonds or bond funds, it provides a good diversification for your portfolio, especially with the income-generating capabilities that fixed income offer, and for the fact that debt markets are generally well diversified globally as well. Most crucially, for fixed income, it is the lower volatility that fixed income offers over equities, making it more suitable for some investors than just all-in equities portfolio. So a question you might be having in your head right now, why of all timings, why now? I see two parts for answers to this question, and the first one is actually quite straightforward. We are past the peak of interest rates, and we do see the downward movement of interest rates across the past quarter particularly. So even if you are specifically looking at Singapore, the federal rate cut since September has actually driven short-term borrowings downwards, and we are seeing borrowing rates falling rather slightly, particularly for 1 month, 3 months, and the 6-month compounded SORA rates in the slides. I think the following borrowing rates is a good reprieve for those with mortgage loans and looking to refinance soon. not to completely exclude the possibility of rate hikes by the Federal Reserve, but based on the current trend of economic data that we are looking at, we are well past the peak of interest rates with the Federal Reserve deciding to cut rates across the past 3 FOMC meetings, 50 basis points in September, 25 basis points each in November and December. So looking a little bit further into the future, just for 2025, the market is still looking at least one cut across the year, and it went up slightly even more, as in terms of the cuts, with the recent US CPI print. However, recently we do see economic indicators do suggesting to be a little bit more resilient on top of the expected economic policies to be introduced by the Trump administration. So, at the same time, also do take note that economic indicators will be very important as to how the Federal Reserve will be deciding on their decisions. So coming back to the question, why now, right? The cost of financing has been decreasing, and based on market expectations, it is likely for us to continue to see a gradual decrease in short-term borrowing rates across the year, and at most, this will be held constant. Comparing against a backdrop of rising interest rates, with rate hikes being a huge risk to the financing portfolio and relevant costs, I believe it is quite straightforward for us to see which scenario is better and beneficial for financing. On top of this, bond yields itself continue to be at a high versus the historical average, despite the adjustments in interest rates that we see in the recent quarter. So for this itself, we'll be running through in greater details for this in the bonds panel session by my colleagues, so stay tuned for that panel as well. But we are still finding bond yields to be really attractive against what we have seen in the past, especially before all the rate hikes has happened. Coupled with the expected falling costs of financing, the question is also, if not now, then when? With bond yields continuing to be at a high, financing costs to fall, and the spreads the investors will earn is only going to be increasing. And further enhancing your yields on the bonds portfolio, if there has to be a timing for us to start looking at bonds financing, there really won't be a better timing than right now. So onwards to the bonds financing parts. So we do find yields now being at an attractive level for consideration, which works even better using this strategy as a yield enhancement method, as we have highlighted below some of the bonds, particularly the SGD bonds for a quick look. For this illustration, we are basing on a 50% loan to value ratio for the bonds, which means if you buy one bond, you can use it as a collateral to borrow the exact same amount to buy another lot of the same bond. So with ESR Group's Perpetual as an example, at a yield to call of 7.48%, a margin loan rate of 4.95%, you are earning an added 2.53% on your margin, enhancing your yields on your original portfolio of ESR bonds to a grand total of 10%. This purely from bonds. In the table, these are some of the issuers that we like at the moment, which each of them representing a different yield and risk profile for investors to look at. And allow me to briefly run through some of the key highlights for this issuer. So for ESR Group itself, quite obviously is one of the more attractive ones. For this, most importantly, there is a step-up margin of 200 basis points. So even though for perpetuals there is a non-core risk to consider, the increased coupon rate based on this step-up margin will be very beneficial for bondholders as well. ESR Group probably came into the limelight recently. For those who might know, it received a privatization offer by a group of consortium that is led by Starwood, Sixth Street, and also SSW Partners. This itself is rather valuable information, especially for the fact that it gives a lot of insights into the confidence that private investors have in the company. So for the issuer itself, ESR actually saw lower performance across the first half of 2024. But despite that, we are generally quite confident in ESR Group, given for the fact that improving real estate outlook for ESR will happen, likely to happen, and the fact that it has been and continues to embark on significant plans to improve its balance sheet and reduce their overall debt levels. So for ESR itself, we do know that we are not expecting this privatization offer to be detrimental for bondholders. Of course, other than do note that there will be a less frequent reporting of financial results, which will likely reduce from semi-annual to annual basis. Coming next up, SPO Lifestyle Limited. So across the three is the only straight bond that has about 2.7 years left for maturity. And at a yield level of 6.3%, you can probably guess how popular this bond is. And plus for the fact that it has quite a limited issuance size. is one of the attractive bonds that is always snatched up on the market whenever it's available. So you might be a little bit more familiar with its previous name, MaxiCash Financial Services, which undernamed a name change when it consolidated the jewelry business from its parent group, SPO Corporation, sorry. This particular issuance is actually part of a recent exchange offer as well, which explains the rather limited issuance size. For us, SPO Lifestyle is one that we are generally optimistic about, given its quite consistent financial performance across the past few years since COVID. So pawnbroking by MaxiCash, the MaxiCash pawnbroking arm, it remains as its very core business contributing the most of its income. But recently, we do see its secured lending platform being an up-and-coming part of the business as well. Credit profile-wise, it has been seeing gradual improvement across the past years owing to the improving performance and results. But at the same time, we would like to highlight that SPO Lifestyle credit metrics lies on the weaker side as compared to other high-yield SGD bond names. Next up, finally, we have the AT1, the Additional Tier 1 by Barclays, which is also known as a COCO bond. Among the three, this is the only one that is rated by major credit rating agencies with a BBB- by Fitch and BA by Moody's, a pseudo investment grade, BA1 by Moody's, sorry, a pseudo investment grade, half high yield. So for investors looking specifically for a rated option, this offers a great opportunity for yield enhancement via bond financing, with this being the highest rated one across the three, while still offering you very attractive yield levels. Coming to the performance of Barclays itself, overall Barclays has performed better and more resilient than what we had initially expected for the first 9 months of 2024. Overall, the Bank of England, the slower rate cuts has actually allowed net interest income to be slightly higher than expected and remains elevated for the bank, while at the same time, the structuring plans that was announced in late 2023 actually helped the bank to reduce operating costs in various aspects. All that being said, we wish to highlight the fact that this bond is an additional Tier 1 subordinated issuance, which is susceptible to loss absorption and also bail-in features, and this might not be suitable for all investors, especially for risk-averse investors. So in a quick summary, there are quite some benefits by bonds financing, especially for the fact that you are able to lock in yields at the price you bought in, and you can simply hold until maturity to enjoy the yields that you bought at. But of course, on the other side, there's also the benefit of using bond funds as part of the financing strategy. In particular, bond funds are able to provide a higher degree of diversification given the portfolio of bonds across the funds, and also liquidity given the fund structure as compared to bonds being traded over the counter. So your investment amount for bond funds typically are much smaller as well, while not forgetting at the same time, funds on FSM1 are typically able to provide you a higher loan-to-value ratio on your portfolio as compared to bonds of between 50 to 70%. One of the potential strategies to adopt through the bond fund financing is through the Japanese yen-denominated bond funds, since yen offers one of the best loan rates at this point of time. Given a standard board rate, as you can see on FSM1 margin facility at 2.08% per annum, the two yen bond fund options we have on our platform, T. Rowe Diversified Income Bond Fund and PIMCO Income Fund, these are offering net spreads of 5.15% and 4.78% respectively. This figure is based on the monthly dividend figures that is paid out in December on an annualized basis. Of course, partnering with our affiliated corporation for preferential rates, the net spreads increase further to 5.73% and 5.36% respectively. Although just a gentle reminder, this is purely based on the dividend payouts coming from the fund and not including the capital changes on the NAV of the fund itself. And of course, through a yen-denominated fund, there will be inherent hedging costs involved for the fund itself. And with every other investment instruments, there will definitely be risk involved and the need to manage such risk. So firstly, avoid excessive leveraging as there can be significant margin call risk in such a scenario. So the important part for investors will be identifying a prudent level of leverage with a comfortable margin and safety. For us, we typically recommend a 60% margin ratio with a minimum buffer of more than 30%. Secondly, the viability of the strategies mentioned ultimately depends on the net spread you are able to earn, be it through bond financing or through bond funds. For Japanese yen, we expect the Bank of Japan's interest rate hikes from here to be mostly on a cautious approach to avoid hurting the economy given for the fact that they only just emerged from deflation. Lastly, currency risk will be present if you are intending to borrow in one currency and the asset class being in another. So for the bond funds, although the funds are being held in Japanese yen, it will be important to note that hedging will ultimately come at a cost for the funds, and this will inevitably eat into the returns from the payouts or the changes in the NAV of the funds. Going a little bit more details for the hedging process, the portfolio manager typically will hedge the base currency with derivatives. And of course, this will help to mitigate the currency risk, but also incur a cost in the process. From what we currently understand, the hedging cost is about 4% per annum based on the conversations with the portfolio managers. But they are also expecting hedging costs will actually decrease to about 2% owing to the changes in the interest rates differentials. And ultimately, we hope that this will be able to provide better gains for investors, especially with interest rates to gradually taper and being beneficial for overall bond investments. So coming to the end of my presentation, here are just some of the takeaways for you to bring back. In case you're still sitting on the fence, there is never a better time than now for you to begin explore bond financing. With interest rates being in the current trend and yields still at a high, there really won't be a better timing for you to take on yield enhancements for your bond investments. Be it bond financing or bond fund financing, we have the options available for investors seeking to explore financing to enhance yields. And don't forget, the process is just as simple as clicking a few buttons either on your browser or on your mobile app, and you can begin your financing journey in seconds. Lastly, financing is made even better with the opportunity to earn higher net spreads through preferential rates with our affiliated corporation. For more information regarding this, feel free to reach out to our product team at the product financing booth. So not forgetting this as well, with the margin, FSM1 margin facility. So for account holders, you can gain access to financing just within a few clicks, and your financing journey can't get easier than this. You don't have to worry about your holdings across your accounts, as your margin buying power will be consolidated for you. Less trouble, more investing. Your cash remains as your cash. You need not worry about how your cash solutions might be impacted. And lastly, of course, do not forget about your loans. Any repayments, any withdrawals can be made anytime at your flexibility. To understand more about FSM1's margin financing facilities, or you have any burning questions to ask, do head over to the margin financing booth and speak to our representatives to get those questions answered. Just for your information, FYI, there's a current ongoing promotion. So refinance your margin loan with FSM1. If you are transferring in your margin loans from other banks, you can get up to $1,500 cash rewards when you are transferring your margin loan balances. And finally, in case you are wondering what this little brown card inside your goodie bag is for, bring it to the margin financing booth and there are prizes waiting for you to be won. With that, I've come to the end of my presentation and all the best at the lucky draw.